If you're planning on renouncing U.S. citizenship, you need to be aware of the exit tax that applies to American expatriates. This is the IRS's last bite at the apple on your worldwide assets, and so it's important to be prepared. And in this video, I'm going to share with you all of the details that you need to know about the exit tax for American expatriates. Hey guys, I'm Andrew Henderson, and if you want to learn how Nomad Capitalist helps 7- and 8-figure entrepreneurs legally go offshore, learn more at nomadcapitalist.com. Today I want to talk about the U.S. exit tax on American expatriates. And by expatriate, I don't mean an expat who simply goes and lives in another country. I mean someone who, as I did, renounces their citizenship permanently. They'll no longer be a U.S. citizen, and what that does is that triggers the IRS coming in, taking a look at their worldwide assets, and potentially applying a one-time tax. Now, other countries do apply this tax. We've made videos about other countries that when you leave and become a non-resident, they will potentially apply an exit tax. The U.S., because they're the only country, effectively, that taxes citizens based on their citizenship and not based on their residence, it works a little bit differently. I think this is especially kosher right now because in the news recently has been the Russian billionaire Oleg Tinkov. He renounced his citizenship, and now the U.S. government is after him because they allege he did not fill out the Form 8854, the expatriation tax return that you file with your final return. They said he did that incorrectly, and there's a whole battle going on. If you want to hear my comments on that case, leave a comment below and I'll consider making a video. Now, who has to be concerned about the exit tax? There are 3 tests. Okay, and if you pass any of these 3 tests, or fail, depending on how you look at it, you are what is called a covered expatriate. We'll talk about that in a moment. The 3 tests are: number 1, at the time of expatriation, the day before expatriation, do you have a net worth of $2 million or more? Now, there's some confusion here sometimes. People think, oh, this is only my U.S. assets. If I have a foreign company or if I have real estate overseas, that doesn't count. Incorrect. Because the U.S. government taxes your worldwide income and worldwide assets. This is their chance to tax everything you own everywhere in the world. So simply moving a bunch of your money overseas and buying real estate or doing whatever else with it, that's not going to solve your problem. They want to know your worldwide assets. $2 million or more, you trigger the test. The second test is tax liability. In 2019, the number was $168,000. If the aggregate federal tax liability averaged out over the last 5 years was $168,000 a year, then you also are a covered expatriate. We're talking federal tax here. So I went to public school, $168,000 times 5, $840,000 that you can have over the last 5 years. And so if you trigger that, then you would also be liable, even if you don't have much money. Okay, so if you're a high-income employee or if you run a business and without a lot of value, but you make money and you pay tax, then you trigger it. The third trigger is if you are not in tax compliance. So if when you expatriate, and there's different arguments on exactly when this needs to be done, but if you're not in tax compliance, then you will also trigger the test. This is a big one for the so-called accidental Americans, people who were born in the United States to foreign parents that never really lived in the United States, but by virtue of merely being born in the country, they are U.S. citizens. And because this concept is so foreign to many folks, they think, hey, I've been living in Germany my entire life since age 1. I work in Germany, I pay taxes in Germany, why would I be liable to the U.S.? What would that matter, right? Well, it does matter, and so those folks often don't tick the net worth threshold, often don't tick the federal income tax threshold, particularly if you're living and paying tax overseas and you benefit from a credit or from a treaty, you wouldn't have any tax liability in the U.S. at all. But what you may have is a situation where you haven't filed your taxes correctly because you didn't know you had to. And so there's numerous ways to deal with these strategies. It's something that we do with folks that we work with. We're not going to get into every different permutation here, but obviously there are different ways to get into tax compliance. There are different ways. By the way, if you're an American doing business overseas and you've got a foreign company, and you didn't know you had to file for that, or if you have foreign bank accounts and you didn't know you need to report those. We had some folks a couple years ago who had been living overseas and legally and paying tax there. They didn't know they had to file an FBAR in the U.S. They were not tax compliant. So there are strategies to get yourself into compliance. There are strategies to deal with the income. There are strategies to deal with the net worth. Depends on a lot of factors, but those are the ways that you can trigger what's called covered expatriate status. If you trigger covered expatriate status, you are now subject to the exit tax, and they go and they look at all your assets. Now you've got to declare these assets when you expatriate on the next tax return on Form 8854. And so you have to self-assess these, but you want to have some valuations behind it. And this is what happened in the case of Mr. Tinkoff. They said, well, this guy was really super duper aggressive in his valuations. I don't know if that's true, but that is the claim that's been made in the media. And so you go through and value all these assets, and obviously, cash is worth cash, whether it's in US dollars or foreign currency, spot rate. On the day before expatriation, that's pretty simple. Real estate depends where it is, depends what kind of real estate it is. Companies, these can be hard things to value. There are processes to value these assets. And so if you trigger the test, basically what they're going to do is they're going to sell your assets. You're not going to really sell them, but they're going to act as if you sold them on that day before you expatriated, and they're going to basically tax you on the difference between the mark-to-market value and the basis of those assets. So let's say you started a company with zero, and now the company has $100,000 in the bank. Well, again, there's some different strategies with that, but I think that it's worth $100,000, right? If you've got $500,000 in a bank account, it's worth $500,000. If you have gold, okay, what's the price of gold today? It's worth gold, and so if you bought gold for $1,000 an ounce and you sold it for $1,100 an ounce, then $100 an ounce times X number of ounces, and that's the capital gains tax, normal capital gains tax treatment. You get $725,000 exclusion in the year 2019. That number, just like the federal income tax number, goes up generally every year. The IRS puts out those instructions. And so that $725,000 in gains comes off the top. If you have a cash flow business, if you have stocks that have run up a lot, I know through the last 10 years, a lot of people have stock gains. They have gains in real estate. Those all get added up, and you can get $725 off of it. But a lot of folks are going to end up paying something at those normal capital gains tax rates. Now, because you're a covered expatriate and because you triggered the exit tax does not necessarily mean that you need to pay. I had a gentleman a while ago. He sold a business for tens of millions of dollars. Business was in the U.S. He sold it as a U.S. citizen. He lived in the U.S. at the time. He paid full boat. All the taxes were paid. Now he had $50 million or whatever it was, sitting in a bank account and in different investments. Okay, he would be a covered expatriate, but they're not going to tax you again. Okay, if the $50 million is just sitting in cash, it's theoretically possible there's no tax due. You just trigger the status. Now, what happens if you trigger the status? Well, theoretically, they're supposed to put your name in the Federal Register as people who have renounced U.S. citizenship on a quarterly basis. That is notoriously inaccurate. We see people who were in the register who were not covered expatriates. We see people who aren't in there who are covered expatriates. So, chalk it up to government inefficiency. But you're supposed to go on the list, the kind of the name and shame list. Who knows what could happen in the future? If you can avoid being a covered expatriate, probably a good thing. I've had a lot of people come to me, and they are younger people who are starting out in business, but they're going, very quickly, and they're growing very quickly. And maybe they have $1 million or $1.5 million. Sometimes it's closer to $2 million, and it's like, okay, now is a good time to make a decision. Do you want to expatriate or not? Because it's only going to get harder from here. Not only will you owe the tax, there's a possibility, this is just my speculation, but there's a possibility that if you look at what Chuck Schumer wanted to do after Eduardo Saverin of Facebook renounced, Chuck Schumer said, we're going to make it so that if you renounced, you can never come back. To me, that seems difficult because you had a very unworkable provision called the Reed Amendment, which I think maybe was used once in 25 years to deem someone inadmissible to come back into the United States on the basis of renouncing for tax purposes. is it theoretically possible that in the future they say, okay, if you're a covered expatriate, we're just going to assume it was for tax reasons. That could be a future law, and you can't come back to the United States. That would be more workable to me than, penalizing everybody who has been living in Amsterdam since they were 6 months old as an accidental American and renounced, and they just want to come back and take their family to Disney World. That's the politics that the Western world is going through right now, is punish the evil rich. And so I think having the status that, it's kind of like, wearing the evil rich tag on your sleeve, you're a covered expatriate, you have multi-millions of dollars, you're a multi-millionaire, maybe that's something to do in the future. And so if you can avoid that status, I would recommend it. So there's an overview of how the exit tax works. You want to do proper planning. And so there are, things that you can do. We work with a lot of, international tax attorneys and tax accountants and coordinate, global plans for folks who plan to renounce. I've been through it. I can tell you there's a lot to think about, and you want to get your ducks in a row, because the last thing that you want to do is not have the right numbers. The last thing that you want to do is not be following the forms. You can get in big trouble for doing that. If you don't follow the form when you renounce, they can come down on you like a ton of bricks also, and take a bunch of money. So you want to be organized. If you're planning on renouncing, you need a plan. You need a plan for what happens to your banking, to your businesses, to your investments, and what happens to the tax when you leave. How can Nomad Capitalist help you? 4 ways. Number 1, subscribe to our channel and click the notification bell to make sure you get our new video every day. Number 2, get a copy of Nomad Capitalist, the book. You'll learn a lot of my personal experiences over a dozen years of studying this stuff, as well as exactly some of the strategies that you can use to build your Nomad Capitalist plan. Number 3, if you're not sure where to start, but you want to come and learn from my team and I, you want to come and mingle with like-minded people, learn more about our live conference, Nomad Capitalist Live. It's coming up soon. And number 4, if you want some help right now because you've got a burning issue, you need something solved, you want to lower your taxes, get a second passport, or build the Nomad Capitalist lifestyle of your dreams, go to nomadcapitalist.com and click on Become a Client.